I'm Todd Healy. On behalf of my partners and associates, Carolyn Smith, Ro Blunt, and Celeste Moya, I'd like to welcome you to this event. And Ro and Carolyn are going to hide, and Barry and I are going to have a conversation. Many of you know Barry from Heckerling, from his work with Forbes magazine and USA Today. He's truly an industry icon in the area of fiduciary responsibility and holding insurance agents and fiduciaries responsible and accountable. Worked with Barry for a long time, known him for, I want to say decades, Barry, and had the honor of watching his company grow. And because so many of you do know him and his name is familiar, and also for those who don't, I thought it might be interesting to get to the information about why Barry has done what he's done with Veralytic, which he describes as a morning star of the life insurance business, where they come in and measure the financial strength of the insurance companies and the competitiveness of products. So Barry, would you mind giving us a little background on how you got to where you are today, please?
Sure, although I try not to refer to Veralytic as Morningstar for life insurance, so I don't get letters from Morningstar's legal counsel, but many of my customers do
Yes,
call
I
it
was to say, it's okay if I do? Yeah.
Yes,
okay.
It's okay for you too.
I won't quote you. Okay.
Yeah, so I actually got started in the financial service business using Morningstar. I was an analyst, junior analyst in a pension investment advisory department of a full service financial planning firm that my father had actually started. He wouldn't let me work for him. So I went, so luck of the draw, I went to go work for the partner who ran the pension investment advisory service or practice. My job was to use Morningstar reports to evaluate the funds in the pension and profit sharing plans of the firm's clients. My job was to take Morningstar, find the funds that had low cost, find the funds that had high cost, find the funds that had good performance, find the funds that had better, and provide them with a one-page report so they could go back to the meetings. Fast forward a few years, I get into to expand my resume, diversify my experience. I go to work for a life insurance agency, and those two experiences could not have been more diametrically opposed. There I was also an analyst, and there I was told that you do due diligence for product recommendations. You run one hypothetical projection that's never to come true, and you compare it to another hypothetical projection that's never to come true. And given my first experience in the fiduciary investment business, that never made sense to me. Fast forward a few more years, I said, somebody is going to invent the equivalent of Morningstar for life insurance. Applied for the first of our patents in 2000, was awarded the first of our patents in 2002, and have been looking for customers ever since. And I will say, Todd was one of our very first customers. So kudos to him for having the orientation, the intelligence and the orientation for fiduciary services.
Thank you. Appreciate that, Barry. You know, we often talk about life insurance being the largest unmanaged and least understood asset in a client's portfolio. Most people on the call have heard me say that more than once. And we ask the question, when was the last time you had it reviewed? Now, you've been quick to identify that I need to tweak that question to when was the last time you had a fiduciary review your life insurance? So because Veralytic is such a big part of our policy review process, and we've worked together for so long, I understand that there's a major distinction between a fiduciary and a non-fiduciary. Would you mind explaining the difference as it comes to your reports?
Sure. So, I mean, just about every insurance agency that I know of offers to do policy reviews. And unless you are in a state that requires a different standard of care that I'm going to describe, which is only one right now, or unless you're working with an advisor who volunteers to do something different than what I'm going to describe, policy reviews are governed by the National Association of Insurance Commissioners Illustrations Model Regulation. That regulation was introduced in 1995 to help make illustrations more understandable, which I still don't think they've accomplished that, and make them less misleading. In 2015, they redid it once because it didn't work the first time. They have since come out in 2015. They came out with AG 49, They've since come out with AG 49A and now this year, AG 49B, because it doesn't work. So the regulatory regime that most policy reviews operate under allow insurance companies, agents, and brokers to quote low premiums, while inside the policy, the insurance company is charging high costs without any disclosure of those high costs, nor the higher risks of underperformance, additional premium calls for more than the quoted premium, or even policy lapse and total loss, even though all quoted premiums were paid. So the fiduciary distinguished that from a fiduciary review, which benchmarks, which is what Veralytic does, which benchmarks the actual charges inside the policy, the actual performance requirements inside the policy, and provides insights on the risks of underperformance. So in one case, you're getting a premium quote without disclosure of cost, performance, and risk, but a fiduciary review doesn't look at the quote. A fiduciary review looks at the cost performance, the underlying cost, performance, and risk.
So, when you look at an traditional in-force illustration and compare that, to your reports, would you explain the difference between in-force illustration and your Veralytic reports?
So whether it's an in-force illustration or even a new business proposal, the insurance companies typically generate what they call a ledger page, which includes a hypothetical premium unless guaranteed, a hypothetical cash value, and a hypothetical death benefit. That is, and then a bunch of footnotes that protects the insurance company from litigation. That is a typical in-force illustration or a new business proposal. What the Veralytic system does is it requires additional pages that are available upon request, but you normally have to request them. Todd can tell you, he's got to ask for them. Those additional pages show the underlying costs and the underlying performance requirements. The Veralytic system then measures those costs against the universe of peer group alternatives and measures those and then quantifies those performance requirements. So even though on the front page of the illustration, it might say that this illustration works at a 5% rate of return, but then inside the illustration, it actually is crediting 6%, 7%, 10%, 13%, 15%, and the Veralytic system reveals that as well.
Barry, you mentioned AG 49 and AG 49B, which I believe kicked in this Monday.
This month, correct.
Monday on the 1st. And what the distinction between those two is, what in a nutshell?
So the entire illustrations model regulatory regime is well intended. I don't have any issue with the motivation behind it, to make illustrations less confusing or less misleading and more understandable. That's a virtuous goal,
right?
But the way that, and in 1995, when they were coming out with this, there was no way to measure cost, performance, and risk. I mean, we were awarded a number of patents because we were the first to figure out how to measure cost, performance, and risk, right? So it did not exist. And so the NAIC came up with a regime that said, okay, we got actuaries calculating premiums for whole life policies, and then we have computers and agents calculating premiums for universal life policies. And so they tried to come up with a way that would make both of those calculations uniform. But trying to regulate an outcome is, I think, an impossible task, and it does not fit clients' best interest. So AG 49A tried to regulate the rate of return that insurance companies can use, but they found a way around it. And AG 49 did that. Then AG 49A tried to tighten the screws a little bit, but insurance companies found another way around it. AG 49B, again, tries to tighten the screws around the rate of return that insurance companies can use to calculate hypothetical or non-guaranteed values. And again, I don't think it's going to work because there's always a workaround, and there's always been a workaround. There will always be a workaround. Clients' best interest practices, like the SEC has now applied to certain types of life insurance, like New York has now applied to life insurance, like California was in the process of applying to life insurance. Clients' best interest practices are cost justified, is performance reasonable, and is risk appropriate to the client's risk tolerance. You're never going to get an illustration to do those things unless you pass a law that says you got to disclose costs, you got to disclose actual performance requirements, and you got to give the advisor the information necessary to assess risks.
And Barry, I know it's been you started off being the only one in the field in an uphill battle. How has the industry and fiduciaries in the area, excuse me, sorry for the sun coming through here, the advisors world, as you've gone to Hecker Lane and whatnot, how has the receptiveness changed in the last 20 years to your model?
So there is a segment of the insurance profession that is embracing this next or new way of doing things. Our biggest customers are actual fiduciaries, trust companies. Ernst & Young, EY, is a customer of Veralytic. KPMG is a customer of Veralytic. So fiduciaries are more inclined to find Veralytic information useful, or in some cases essential to their world. And then there is a relatively small but still growing group of insurance professionals like you, Todd, who had the same experience that I had, probably, that comparing one hypothetical illustration that's never to come true to another hypothetical illustration that's never to come true just doesn't make any sense.
Yeah. Yeah. One thing we know about those illustrations, the numbers will be different 6 months and 1 year, 5 years from now. That's why the management and the review is so important.
If I can add to that, so from a fiduciary's perspective, the FINRA has issued a rule that says that comparing illustrations, unless you compare cost, performance, and risk, comparing hypothetical values is misleading. So here is a industry authority with an objective to protect the consumer, who says that if you compare hypothetical illustrations, you are providing misleading information to the consumer. The Society of Actuaries decades ago published a study that said comparing illustrations is not just inappropriate, it's fundamentally inappropriate. And most recently, the OCC updated their handbook for unique and hard to value assets and added a chapter for life insurance saying that these illustrations are highly volatile and therefore not very reliable for using as decision support, right? And so if you're a fiduciary and you've got just hypothetical illustrations in the file, you've got to somehow argue, if a client ever complains, you got to somehow argue that the decision support, these hypothetical illustrations, were not misleading, even though FINRA says they are, were not inappropriate, even though Society actually said, and they're not unreliable, even though the OCC says. So I just think you've got to, as a fiduciary, you've got to have more information. I knew that when I was an analyst in the pension investment advisory department, and so that's why I created Veralytic.
Well, and as we got 1 minute here wrapping up this morning, Barry, the original model for Veralytic, as I understood it, was existing policies. We've been using them in addition on new policies before they're placed, especially with advisors who don't have the background. And I'm gonna put a little commercial for you. And advisors can go on your website and request a Veralytic report without having another fiduciary involved. So that's one thing to put a plug in. And the other thing I know you've been involved with.
Although please forgive the look of our website. It's a little bit dated. We've been focusing on building our customer base, and our website needs an update. It's scheduled to get one this year. Don't judge the book by its cover. Go ahead.
So they are better off coming through us then?
Yes, they are. Absolutely.
Okay. All right. Barry, as we wrap up, you've been involved with the Center for Board Certified Fiduciaries.
Yes.
Can you give a 30-second description of that as we wrap up, please?
So there are fiduciary, I call them fiduciary silos, where, somebody who's in the qualified plan business, fiduciary rules are slightly different than people who are in the private trust business or the ILET business. And so the goal of the Center for Board Certified Fiduciaries is to create a uniform frame, or it's not goal, it's what the Center for Board Certified Fiduciaries has done is to create a unified framework for all assets under the advisor's care for the first time to include life insurance. And they just launched, go ahead.
Yeah, I'm sorry. We
That's
will
okay.
send a link. We'll send a link to the people on this call. And also there's an article you said you'd make available to us that you've written regarding some of these issues, because they're so critical to everybody. So again, on behalf of my partners and associates, want to thank everybody for joining us this morning. Barry, thank you very much for taking your
pleasure.
time and sharing your expertise with us and giving us some additional clarity on the difference in fiduciary and non-fiduciary responsibilities. With that, we'll say good morning and hope everybody has a great day. Thank you. Bye.
Bye-bye.